Yeah, great question. What I think we're seeing is that 1.2 million people decided the fate of Britain out of the EU, and you're right. The tone was very sympathetic at first. It's gotten hardened because I think they realize how much work has to be done between now and the next 2 years and what that means, and the fact that Britain is putting its heels down on a lot of different issues. It's just making it very, very complicated. I think it's going to be one of those things we're going to continue to see drama as things unfold. And I'm starting to believe that maybe this will never happen when you consider the fact that Scotland and Ireland they want to remain. And you have a lot of the UK that wants to remain. And yeah, it's going to be interesting. But yes, I do agree that the sides have gotten very callous over the last 12 to 24 hours.
Let's talk through what the impacts that we've seen on markets. We did see a bit of a clawback both across Europe and in the US. The companies that were hit hardest in the immediate aftermath were obviously those with the greatest exposure to the UK directly, but also to Europe. The big banks were hurt hard, but also we saw energy stocks beaten down because of a lower oil price, and some of those companies like Apple I mentioned in the introduction who had exposure to selling into those markets. They've done a slight recovery today, although obviously nowhere near to exactly what they were before the Brexit vote. How do you think this plays out? Do you think it's now the prices are baked in with the uncertainty, or will it be a daily volatility depending on what words come out of, say, Chancellor Merkel's mouth?
Well, I think the volatility is coming out of the market very, very quickly, a severe reaction to the market. But we weren't deeply oversold yesterday, so I don't think this bounce back has anything to do with a deeply oversold condition. And clearly, valuations of the S&P 500 are nowhere near cheap right now, even with the market still down from where it was even a week ago. I think a lot of it is just uncertainty, and the fact is, when the S&Ps were trading up above 2,100, people that are long the market at that point are making a big assumption on earnings per share next year of $130 and very comfortable with 18 times earnings. Now, we know that when valuations get that high, it doesn't take much to undermine the market. And I think that's exactly what happened. Right now, traders especially are very worried that we're going to see non-fundamental selling come into place like we saw last August, where program trading have to sell for any reason or no reason at all. So far, that hasn't given way. That hasn't happened. But that seems to be the biggest fear.
Let's talk through the old maxim, selling may go away. Do you feel like the second half of 2016 is going to be particularly painful? Are we getting a lot of investors potentially moving away from the markets, just thinking that the volatility that we're going to see, even with the Brexit vote out of the way, we still have a US election which looks to be particularly polarised. We still have huge doubts over what's happening in China. There is a lot of uncertainty, not to even mention what's happening in South America, where you have a president on impeachment charges, Venezuela in chaos. It's a pretty scary world out there in a world of great volatility. Are a lot of investors just choosing to sit on their hands?
Yeah, I think so. But also with that pain is going to come this pain trade that we've been witnessing for so long now, and it's going to reinforce itself now with rates being lower. Now that it seems pretty clear that the Fed's not going to be raising anytime soon, I'm going to hold out till December. But with that said, there's still going to be demand for yield, and people are willing to pay for defensives, high dividend yield stocks, et cetera. So I think you're going to continue to see that pain trade play out, even though I think it's a scary endeavor, and I continue to be underweight equities.